As the coronavirus pandemic spread across the globe, central banks rushed to limit the economic damage with unprecedented aid.
This is the time to use the great fiscal power of the United States to do what we can to support the economy.
The bank will take all necessary further steps to support the UK economy.
These measures have not only prevented the economy from entering depressed and deflationary conditions, but they've also contributed to supporting employment and to reducing financial stability risks.
It didn't take long for mounting concerns about rising moral hazard.
There's an underlying credibility issue here. Will central banks be able to do what they promised to do with this set of tools?
The Federal Reserve will be faced with the challenge of whether they allow a day of reckoning. Corporate America is going to become addicted to the Fed providing support.
There's no limit to how big the Fed balance sheet can get, but you have to understand that there are some risks there for the Fed.
To others, it was necessary to save the economy.
You throw everything you got at the virus. You hit it, you kill it.
Welcome to a Bloomberg special report, 2020 Year in Crisis, the Moral Hazard Threat. I'm Shonali Basak. As the world reacted to the deadly coronavirus threat globally, central banks were focusing on limiting the devastation to the global economy. The U.S. Federal Reserve started a massive effort to shore up the economy in mid-March by promising to inject trillions of dollars into overnight funding markets. And that was just the beginning. On March 17th, the Fed announced a commercial paper facility to give corporations more direct access to funding, a method that hasn't been used since the financial meltdown a decade ago. The European Central Bank acted in concert, promising to buy hundreds of billions worth of securities in the public and private sectors. Central banks around the world began propping up their own debt markets, and the Fed extended them swap lines to ease up dollar funding strains globally. In early April, Fed officials made additional drastic moves as job losses ticked into the millions. It pledged to support billions in loans to small and medium-sized American companies, something that has yet to take effect on a large scale. It also said it would backstop corporate America by funding the purchase of risky debt such as junk bonds, where typically the Fed has stuck to investment-grade debt. Investors are raising warnings over moral hazard and whether the Fed's moves would prompt companies to take on an inordinate amount of risk. With the Fed's intervention, many firms could start borrowing a lot more money with little respect for the consequences. It's clear that the Fed spurred record borrowing. In the first 6 months of this year, investment-grade bond issuance has topped $1 trillion, a record for such a short time frame. Even companies that are rated below investment grade, like Macy's and Ford, have raised billions. At the same time, S&P Global Ratings has downgraded more companies than they have in the past decade by a very large margin. In fact, downgrades this year are already on track to be triple the average of the last 10 years. The worry is that this would create a legion of zombie companies, saddled with debt and limping along, paying back the interest, but not really becoming more productive or hiring more workers. In fact, many of the companies that have borrowed billions this year have laid off more workers. While millions of Americans were put out of work because of COVID-19, in April, Loretta Mester, Federal Reserve Bank of Cleveland president, stressed that the Fed was preventing further damage to the economy.
At this point, I don't think we can be that concerned about those kind of moral hazards. I really think we have to really look at this is a hugely impactful and negatively impactful shock. And we have to do all we can to make sure that we're not doing permanent damage to the underlying fundamentals of the economy.
While the Fed was focused on protecting those underlying fundamentals, former New York Fed President Bill Dudley said that support for corporate debt could encourage risky behavior.
Well, I think the Fed's focus has been on basically making sure that financial markets work well so people can actually have access to the markets. And that's really the reason for the interventions. I mean, even their intervention into the high yield debt market, it's not so much to bail out individual borrowers, but to make sure that people actually can access that market and raise high yield debt. And I think they've been quite successful in those efforts. But you raise an important point. People who have high yield debt outstanding, a lot of times that's happened by choice. And so for the Federal Reserve to intervene and support those asset prices is basically creating a little bit of moral hazard in the sense that you're encouraging people to take on more debt.
So let's talk about the moral hazard and broaden out the implications of this period of time. There have been some analysts who say the reason why the Federal Reserve really, I don't want to say had to, but in some ways had to step into the corporate debt market was because of the expansion of the shadow banking system. In some ways, they were bailing out the shadow banking sector rather than the banking sector, which was actually well capitalized. How important, in your view, is it to set regulatory standards for the shadow banking sector that are sort of more similar to what we see on Wall Street following this, given the fact that perhaps this can be viewed as they're having the systemic import of Wall Street of the past?
I think you raise a very important point. If something is systemic, that's then going to require the central bank to intervene in an unusual way in the middle of a crisis. If it's systemic, then it needs to be regulated to some degree. And so we had a number of players in this last few months that have essentially been bailed out by the Fed. People who hedge funds that were invested in cash treasuries and short treasury futures. The Fed basically their treasury purchases were helping those entities unwind what turned out to be a bad trade. If people become very leveraged and they're big enough to be systemic, then I think there needs to be some regulation to reel that in. What the Fed really wants to avoid in these kind of episodes is where people have to dump lots of assets into the market and there's no buyers, and that then distorts markets significantly. One way to avoid that is to make sure that people actually have access to liquidity. Another thing the Fed could do is basically say, look, you have to buy liquidity insurance from the Fed during peacetime, so it's available during wartime. So there's a number of things that I think are worth exploring because it's one thing if you have a financial crisis every 50, 100 years. If you start to have a financial crisis every 10 years, then the Fed's actions are going to encourage people to take more risk in the future.
Taking on more risk with the Fed's backing is at the middle of the moral hazard argument, and investors like Guggenheim CIO Scott Minerd worry that the Fed will face a day of reckoning.
The Federal Reserve has basically eliminated the downside in corporate debt. They've sent the world a buy signal, and as we're now putting on record amounts of corporate debt, the leverage situation is even getting more exacerbated. So I think ultimately the Fed is going to find itself in a position where when it tries to phase out these programs of support for corporate debt, it will be a lot like what happened back in 2013 when Ben Bernanke first talked about ending quantitative easing. There was a tantrum. Corporations will take greater risk. That if you don't have a highly levered balance sheet relative to your competitors, your equity returns will be punished during business expansions. And so pressures will be on CEOs to continue to increase the amount of leverage, especially when the Fed has got a policy of maintaining low rates for an extended period of time. So I think that ultimately, is there a day of reckoning? I think that the Federal Reserve will be faced with the challenge of whether they allow a day of reckoning or whether they basically decide that they just have to continue to provide liquidity to the system until inflation rates pick up to levels that probably would be viewed as unacceptable by most participants of the Fed today.
Because central banks around the world expanded their balance sheets so aggressively, investors are concerned that global stock and bond markets will feel the aftershocks for many years to come. One such investor is PGIM's Nathan Sheets, who has previously worked at the Fed and Treasury Department.
I think there's a very serious question that's related to this moral hazard issue. And that is, do we want to live in a world, do central banks themselves want to live in a world where their interventions are so central to the market outlook and to market performance?
Coming up, how the moral hazard threat keeps unproductive firms alive. That's ahead in 2020 Year in Crisis the moral hazard threat. Welcome back to a Bloomberg Special Report, 2020 Year in Crisis, the Moral Hazard Threat. I'm Shonali Basak. Torsten Slok, the chief economist at Deutsche Bank, has warned that zombie companies in the United States has been surging for the past decade. These are companies that have debt servicing costs that are higher than their profits. And this is true for companies around the world. It can put pressure on governments to eventually bail out these zombie companies that are struggling. Guggenheim's Scott Minerd warns of the pressure that debt levels are placing on the economy.
We already were at record levels of debt on a number of measures from corporations when we got into January of this year. And one of my concerns was that when we have an economic downturn, this highly levered economy of ours was going to lead to more severe pressures on the economy than we would normally have.
That means many unproductive firms are being kept alive, which can put a hole in economic growth rates moving forward. What's more is that companies that are borrowing funds are often firing people by the thousands. Often companies are left with the choice of adding more workers or paying back their investors, and they have more pressure to do the latter.
Why should we be spending hundreds of billions of dollars to support the junk bonds of companies that somebody bought up, levered up, and took a lot of money out, and not spending money helping inner cities where people are dying?
I very much worry about Europe and Japan in particular. As you think about sectors and competitiveness, for example, the retail, the non-traded goods sector in Japan has for many years been sheltered from intense competition. And I think these low rates that we're seeing tend to allow them to extend their lives and reduce the necessary return on capital that's required to keep them in business. And I think that does kind of blunt the process of creative destruction that would otherwise occur.
These concerns about employment and productivity are mounting all over the world. The Fed's balance sheet expanded beyond $7 trillion, while the ECB's has surpassed 6 trillion euros. The Bank of Japan's is bigger than 640 trillion yen.
These measures have not only prevented the economy from entering depressed and deflationary conditions, but they've also contributed to supporting employment and to reducing financial stability risks. Faced with that extraordinary shock, we need extraordinary measures.
You throw everything you got at the virus. You hit it, you kill it, you win the war against the virus. You throw everything in terms of finance, in terms of budget resources, in terms of health resources, because the sooner you beat the virus, the less expensive the recovery will be.
The most criticism of Lagarde's programs, I think, and Draghi's programs came broadly from Germany and other countries in Northern Europe. And I think there is a very entrenched concern that stimulative central bank policies lead to inflation. And that's true notwithstanding the fact that the ECB is missing its target on the downside, that there is this worry that we're laying a foundation for a more inflationary economy. And then secondarily, I would say that there is skepticism on the potential costs of interventions in markets along the lines of the moral hazard discussion that we've been emphasizing. What does it mean for risk taking? And if investors are bailed out at key times, does that mean that they won't evaluate their investments as carefully?
Washington, both fiscal and monetary, has given a lot of support to the marketplace. Let me ask you, has it really been necessary? For example, when the Fed came in and started buying corporate bonds, not ETFs, but buying corporate bonds, did that really need to be done? Were the spreads really blowing out that way?
Yes. I would say that there was, if you go back about 2.5 months or so, there was absolute illiquidity in the debt markets, short term and long term. No company could finance investment grade. The highest quality companies, when they tried to roll over their commercial paper, found it difficult to do so. So we had a real severe liquidity crisis, and the further down the credit spectrum you were, the more severe it was.
But Ralph, does there come a point, at some point, where it starts to distort the marketplace?
Well, there's certainly an element of watching what the Fed does, and certainly if you're a market maker or a trader, you're not going to want to be on the other side of a trade of an investment that the Fed is making.
I think the COVID crisis, has certainly highlighted unforeseen risks that disproportionately impact companies with excessive leverage. And so you can never predict these kinds of risks. But obviously companies that have leverage have less flexibility to deal with those risks, to pivot their capital structures, and unfortunately some of those companies end up in trouble. And so I do think on the margin it will highlight for investors some of those risks inherent in overlevered balance sheets.
The surge in debt levels is not limited to corporations. Investment firms like private equity and hedge funds have also been ramping up on cheap debt for the better part of a decade and now have to grapple with high degrees of leverage. The Bank of International Settlements has even said hedge fund leverage has added to more stresses in markets and has impacted the normal trading of government bonds. That means investors and regulators are becoming more concerned about rising debt levels at Wall Street firms, corporations, and governments, all while central banks provide a backstop to markets. Coming up, how the moral hazard threat impacts the broader economy. That's ahead on 2020 Year in Crisis, the moral hazard threat. As central bank balance sheets have expanded, there are certain risks that moral hazards create for the economy and for ordinary people. One of those risks is greater unemployment as companies lay off workers to pay back debt instead. Another risk is the ability of central banks to control inflation, meaning citizens have to pay higher prices even if people are unemployed. The views from central banks are mixed.
We judged that it was necessary to increase the size. And I can assure you that there was an unanimous view in the Governing Council that action had to be taken. In the face of that inflation outlook, and given our mandate of price stability, action had to be taken.
But indicators of longer-term inflation expectations have remained fairly steady. As output stabilizes and the recovery moves ahead, inflation should stabilize and then gradually move back up over time, closer to our symmetric 2% objective. Inflation is nonetheless likely to remain below our objective for some time.
We are faced with a cloud of uncertainty about the course of the pandemic and the economic damage it will leave behind. Inflation is likely to fall much further in the coming months.
Top investors like Bridgewater's Ray Dalio have voiced concerns about rising debt levels, and others are concerned about rising inflation.
As demand comes on and as supply chains get strained, I suspect you're going to see price increases. And over the longer term, meaning over the next 3, 5, maybe 10 years, I think this significant amount of fiscal stimulus that we're having in the world will create an inflationary cycle.
Like in the 1930s period, when you had deflation of goods and services, and you had inflation because of financial assets and other things because they produced it. And so you saw a series of currency declines.
The big divide is the people who don't understand why stocks are where they are, and the people who do understand it by interiorizing the old motto, you can't fight the Fed.
One of the major challenges that we'll have on down the road is as debt levels rise in the economy, what's the implication of that? Well, it means that we have a riskier economy, that high debt levels at some point may lead to downgrades or even defaults. But it also means that we will have a less vigorous economy, which kind of ties into your point about zombie companies, which are one manifestation of that. But another manifestation of that is the so-called balance sheet recession, where you have firms that have lots of indebtedness say, wow, I've got to do something about that. And as a result of their high debt levels, they stop hiring, they stop producing, and they just try to pay down debt, which Japan's experience highlights, creates enormous drag on the economy. So there are a range of financial stability risks that might arise as a result of this, but there are also meaningful risks in terms of growth and employment and the broader performance of the economy.
Meanwhile, moral hazards have created higher prices in stock and bond markets, regardless of potential risks that are mounting. For example, the stock market has risen more than 20% since the Fed's March actions through June 15th. And that's even as the unemployment rate surpassed 13%, and Powell himself said he believed it will stay elevated, and economic growth globally has slowed. That's created concerns that ordinary people have not been benefiting as much as Wall Street, which is gaining from the extra risk investors are willing to take on.
Fed's monetary policy tools are really about supporting economic activity and driving the economy to higher levels of employment. However, that can actually cause financial asset values to go up, and that can actually exacerbate inequalities.
The question is, will the policy changes that are coming out be done in a way which encourages increases in productivity and output, living standards for all Americans, or will it just become a fight for the pie? That is, that we need to cut up the pie again, and we need to basically transfer wealth in some mechanism, whether that's through income or whether it's through taxation or expropriation. And those sorts of policies have historically proven not to be very productive and to actually lower living standards over long periods of time.
We call it out as an important factor in the economy, and we will use our tools to support maximum employment and take that definition to heart. But obviously that's something that's going to require an all of society, all of government response. A lot of the lost jobs were from people who work in the service economy dealing with the public, for example, and relatively, compared to other jobs, relatively low wages. So if you just look at what that is, unemployment has gone up more for Hispanics, more for African Americans, and women have borne an extraordinary, a notable share of the burden beyond their percentage in the workforce. So that's really really unfortunate.
Thanks for watching Bloomberg's special report, 2020 Year in Crisis, the Moral Hazard Threat. I'm Shonali Bassick for Bloomberg Television.